Chapter 18 was where we figured out what money was, okay, and sort of how it works, who takes care of it, who runs the show, and who those people are, right? So Chapter 19 is how we make money, and it's not about earning money. This is not about profit, okay? This is about something even deeper. It's about magic.
I told you it was fairy farts and rainbows. I knew it.
Magic. Money is made by banks out of magic. Now, that magic, the magic words that you have to say, right? So the magic words, normally you think it's like please or abracadabra, right? Unfortunately, the magic words here are a little bit more economic. The magic words are fractional reserve banking. And you may think those don't sound very magical, and you may even try saying them and see if money magically appears in your hand. It won't. Well, I mean, unless you put it there. And you may hope that maybe if you put some money there and then say the words that the money somehow multiplies or clones itself. That doesn't work either. But the key, of course, is that you have to be a bank in order to do this. Okay? So really the magic words only work for banks, which is a bit of a bummer. But it does work. So you're probably wondering, wait a second, how do they do this? Okay, so let's learn a little bit about banking. There are two terms you're going to want to know about. Banking is very fun, folks. You're going to love bankers after you hear this chapter. Or hate them, one of the two. Okay, so the idea behind the magic, right, is that when you deposit money in a bank, what happens to the money, right? The money converts itself into one of these two things, either required reserves or excess reserves. Or excess reserves, all right? And the key here is that the person that, or the group that tells you how much of the money is required and how much of the money is excess is all driven by the Fed, right? So the Fed sets the fraction, that's an R, or the percent that is required. All right, so let's imagine, if you will, that you guys walk into your bank and you have $1,000. Well, now let's make it a little bit better. You guys just worked for 2 weeks and you got paid, and so you're going to take your $5,000 check and deposit it into the bank. Because that's how much you guys should make in a 2-week session, right? Yeah. $5,000? All right, so take $5,000 and deposit in the bank. So normally, or for the last 70, 80 some odd years, the Fed has set the required reserve ratio, or the percent of the fraction of deposits that must be in reserve, is somewhere between 9 and 12%. Okay, so basically 10%. So the idea is that when you get $5,000 into your bank, or you put it into your bank must take 10% of that money and either put it in its vault or deposit it into their account with the Fed. So they take 10%. So let's suppose that our required reserve ratios are 10. So they take $500 and they put it in their vault. So imagine, if you will, you guys got paid in cash. I won't ask in what denomination, because if it's singles, it's none of my business. So
that was a delay.
they had to think about it, I understand. So the rest of the money becomes excess. Now, excess reserves, the key to excess reserves, these are loanable, which is normally what banks like to do with money, right? They like to lend it out, right? Required reserves, by law or by federal regulation, they have to hang on to it. So when you give them $5,000, they're going to add $5,000 to your checking account, right? Now, this money stays here. What does the bank do with the $4,500? They lends it out to someone. So suppose I come into your bank a couple hours after you've deposited your check, and you say, look, I need $4,500 to start my own school. Right, so I've decided that this is my new business venture, is I'm going to start the School of Marshall. And, I just need $4,500 to do it, right? So I'm going to buy a really nice server, and it's going to be an all-online school. Not a bad idea, right? So the bank says, oh, okay. They take that $4,500 that was originally yours, and they give it to me. They're going to charge me some interest. That's their profit, okay? The interest that banks earn, folks, is strictly profit. That's not how they make money, okay? That's how they earn it, technically. The way they make it is that, think about this money in terms of the money supply, right? So that $5,000, when it was cash, it was part of the money supply, right? $5,000. When you put it into your checking account, even into your savings account, either one, it's still $5,000 worth of the money supply, right? Now, when that bank takes $4,500 out of its vault and gives it to me, did they take the $4,500 away from you guys' $5,000 deposit? No, you guys still have $5,000 in your checking account. But now I have $4,500 in cash. What happened to the money supply? It just went up, right? This, as soon as they give me the $4,500, is now additional money in the money supply. Where did that $4,500 come from? It came from the deposit, but did the deposit get subtracted by $4,500? The interest is how they earn money, okay? But this $4,500, if you think about it in terms of the money supply, where the Fed is counting up all the money that's sitting in people's deposits, how much money is sitting in their checking accounts, how much is sitting in their savings accounts, I will probably take this $4,500 and put it in the bank, right? And then write a check to buy all of my servers. Well, if I put this $4,500 in the bank, where'd that $4,500 come from? Yeah, it didn't come from anywhere, right? The Fed didn't print $4,500 worth of cash, right? It's not new money, but it came from the fact that you guys put $5,000 in your checking account.
Okay. So now is there another $450 going into required reserves?
Exactly. So this $450 are required. What happens to the rest? $4,500 excess. And what is my $4,050? Lend it out again. They're going to lend it out to someone. As soon as they lend this $4,050 out to someone else, what happened to the money supply? It just went up another $4,050. Crap. So this $5,000, it increased it by $4,500. Now it just increased it another $4,050. Yeah, And suppose you, Matt, get the $4,050. What are you going to do with it? You're going to stick it in the bank. What's your bank going to do with it? It's going to hold 405 of that 10%, and it's going to lend the rest of it out. What's going to keep happening to the money supply? It keeps growing and growing and growing. And again, the Fed didn't do anything, right? They didn't print any more money. They did nothing. All they did was said this. They said abracadabra, essentially. Is it?
Not when most people don't even deal in dollars anymore. They really
People
don't.
aren't
I
paying
do.
that back nowadays. A lot of people are filing bankruptcy. I mean, then what?
And then banks fail.
Yeah.
That's what happens, right? That's part of why banks were failing, is because people weren't able to pay back the debts that they had incurred. And that's what a bank has to deal with, in theory.
That's when the government bails them out and hands them a bunch of cash.
Potentially, yes.
But they're just holding it, right?
Yeah.
So it's not technically just going to the Fed and staying. It's not like they can just keep it.
What do you mean keep it?
The people? The banks or the people?
The Fed.
The Fed, yeah.
The required reserves is going to the Fed, right?
Yeah, the required amount, right? So this $500 is I mean, it may be cash, though. I mean, the bank may hold it in actual cash.
So is that just their payment to the Fed?
Yeah, essentially, right? It's the denotion to the Fed that we are keeping a safe amount of that 500 deposit on account.
So it's still technically this bank's.
Yeah. Mm-hmm.
Okay.
The $500 stays at this bank's. And really, so does the $4,500, right? Because, I mean, when you guys put your check in there, I mean, your checking account got debited $5,000. I mean, your checking account doesn't go down when they loan the money out. It's still there.
So then it stops if you just take the cash?
Yes. That's what, unfortunately, the problem with this, right, is that, in theory, this should keep going on over and over and over and over and over again, right? But if, for some reason, let's suppose Matt gets the $4,050 and says, oh, wait, no, I'm not going to deposit it in my bank. Instead, I'm just going to walk around with $4,050 in his pocket. I mean, first of all, how's Matt going to start walking once he's got $4,050 in his pocket? Hey, how you doing? I'm feeling pretty good. Right? I mean, come on. If you've got $4,000 in your pocket, what are you doing? You are strutting a little bit better than normal. I mean, I would be, right? I mean, that's how it works. But the idea, though, is that may stop the flow of money from growing, which is disappointing from the Fed's perspective, because actually the Fed wants this to happen, okay? The Fed's job is to keep track of the money supply growing a little bit. And so when it sees these numbers, sees deposits happening in bank accounts, they're like, oh, that $5,000, it's going to add to the money supply a certain amount of money. That's what they expect.
Does that $500 insure the bank that then the bank can come up with this magic money?
If it needs to, in theory, yes.
Okay.
The idea, of course, is that how often do you go to your bank and demand this $5,000 back? Yeah, very rarely do you, right? So they don't have to worry too much about it. That's what they've discovered through statistical analysis, is that by holding 10%, that's essentially enough so that the bank won't get run and run out of cash.
So does anyone know, like, how much money there actually is in the world?
Yes.
I mean, like, what's the percentage?
You mean the amount of cash there is, or the amount of money supply?
Cash.
Cash. There is some, just a little bit less than $1 trillion worth.
More. How much do we think we have? I mean, that's what I'm saying. Like,
What's the actual money supply? Oh, about 19 trillion dollars. Yeah. Well, I mean, think about it, right? I mean, we are not a cash-based system anymore. Sir, if you would have gone back in the 40s and 50s, the money supply would have been like, 2 or 3 trillion, and the amount of cash would have been like 750 billion.
The gap is smaller.
Yeah, but now the world is mostly run on blips and chips and zeros and ones in a bank's computer, so cash is unimportant.
But so, like, if someone pressed the buzzer, it's just the first 1/18th of the people would actually get their money, never else.
Yeah, in theory, yeah.
Fast.
Well, I mean, that's what happens with bank runs, right? I mean, that's why people run a bank, is they think, oh my goodness, this bank is quote unquote out of money. And so they all run in to try and get their deposit back because they know that the bank is only holding 10% of it, right? And they're like, well, shit, I better be one of the first ones, or I'm not going to be able to get my money, right? Of course, now remember that when you put this $5,000 in the bank, don't forget your buddy. Federal Deposit Insurance Corporation. This is what guarantees that as long as you have $150,000 or your account, you will always be able to get it, because if the bank runs out of money, the feds will step in and give it to you. And again, the idea is that that's what stops people from running a bank, because they know that if the bank runs out of money, the government will step in and cover all of those deposits. Well, yeah, as long as it's not over $150,000.
That's why you should have multiple bank accounts.
Well, that's why their money is sitting in the Cayman Islands, because they can only put up, there's only $150,000 insurance. Right, I mean, it's they do have to be on different banking, tax ID banks, though. So they're, yeah, basically. But
Somebody robbed the bank.
bank,
Like sucking for
well, no, the banks actually have to have their own robbery insurance that pays for them. Same as you guys have homeowners insurance, right? If your home gets robbed, what do? You make a homeowner's claim. When a bank gets robbed, they make a bank owner's claim.
who owns the bank owner's insurance?
There's different companies that do.
Like a good neighbor.
Yeah, it's essentially, mostly, what was the, AIG, that's the biggest one. Of course, that was the, yeah, enough said. All right, so the question then is, how much would the money supply grow from this $5,000 deposit, as long as nobody like Matt decides that he has to become a cool guy and strut around with $4,000 and doing it.
You had the 5,000 plus the 500 plus the 4,500 plus the 4,000.
Not the 5,000, right? Because the 5,000 was already cash, which meant it was already part of the money supply. But the $4,500, once you loan it out, that's new money, right? Nope, you don't add the required reserves, because those don't go out there. Those the bank is holding on to, right? So the new M2, or the new money supply money from $5,000, starts with the $4,500 plus $4,050, right? 90% of that. Essentially, keep taking 90% of that. So what's 90% of that? 3,645, right? Plus, so keep taking 90% of the money, right? And this is a little bit more mathy than I want you to do, so don't worry about this part of it, because it's going to work out to be a nice, easy formula. Because the idea here is that we're adding a whole bunch of numbers that are continually cycling a little bit lower. What did we do back in chapter, 15, when we started talking about the spending multiplier? And the taxing multiplier. What did we do? We said, well, when we get $100 in cash or $100 in payment, we're going to spend 80% of it on GDP. And that 80% is going to go to the business. And what are they going to do? They're going to spend 80% of it on GDP, 80% of it on very similar, right? So if we had a spending multiplier and a taxing multiplier, guess what we're going to get? Well, except what are we talking about now? Essentially, it's a money multiplier, if you will, all right? So what is the money multiplier? Because you're expecting that, just like you were expecting spending multiplier. Well, you probably weren't expecting spending multipliers and taxing multipliers, but now that you've seen them, you start to see the pattern. If you keep seeing a number that's going to cycle a little bit smaller but keep adding and adding, you should just have to multiply by one value and not have to do all this crap, right? And this one is even easier than it was before. It's just 1 over the required reserve ratio, which, just so that you know, I will tend to abbreviate this. And you kind of have to slip into pirate every time you talk about this, because this, of course, is 1 over the R. Good. Right? So the required reserve ratio. So it's the R. Get your pirate hat on, turn it sideways, whatever. Put the hook on your hand, however you want to do it. And the idea here is that if our required reserve ratio of 10% as a decimal is 0.10. If you take your calculator out and 1 divided by 0.1, you will get 10. When you add all these numbers up, this is how much new money we made, 4,500. Guess what 4,500 times 10 is? 45,000. And that will be the sum of all the new money that's made. So the idea is that a $5,000 deposit, which creates 4,500 new dollars, will eventually or potentially add $45,000 to the money supply. And the Fed actually expects this to happen every time a deposit occurs. And realize it works the other way, though, too, right? So every time you pull money out of your bank, the money supply will decrease by 10 times however much you pull out of the bank, right? And so what happened to our economy in 2009 when a whole lot of people's money disappeared? What a lot of people did is they said, oh my goodness, you know, I'm afraid that my cash or that my value in my bank account is going to be gone. What did they do? They pulled their money out and bought gold instead, right? Again, they pulled money out of their checking deposits, out of their savings deposits. What was that doing to the money supply? Lowering it and lowering it and lowering it and lowering it. If you've looked at our money supply in the Fed, in the economy in 2008, the amount of money in the system went from about $17, $18 trillion down to about $15 trillion in a matter of 6 months. I mean, $3 trillion in the money supply literally disappeared. I mean, imagine if you accidentally lost $3 trillion. Yeah, This is why the crap was hitting the fan so hard back in 2008, 2009, right? Is that not only was it hitting all of the consumers' pocketbooks, but it was hitting the whole monetary system of our country equally as hard. All right? So this money multiplier, though, again, please realize that it's how much new money is made from a deposit. Okay? So the $5,000, you don't multiply by it. You multiply by that first take back, right? Because this $5,000 was already in the system because it was cash, or it was a check in a bank account somewhere. So that was already there. This, though, is completely new. It was made out of magic. Right? And this is why a lot of people consider the banking industry to be made of a bunch of shysters who create money randomly whenever they feel like it. And, well, yeah, it's true. Good or bad, I don't know. I mean, it's worked fairly well so far, but, I mean, this is literally what's going on a regular, right?
So do they actually keep track of each individual deposit and withdrawal, or at the end of the day, do they just...
At the end of the day,
together?
yeah, end of the Fed gets a report every day from every bank telling them what every transaction occurred in their system. The Fed aggregates that every day. That's their job. So yes, literally the Fed is, I mean, they don't do it on a per transaction basis, but they know how many deposits a bank had and how many withdrawals it had on any one given day as a total, and it uses those to determine how the money supply has grown or shrunk every day.
How do they decide the percentage for the required reserve?
Oh, they set it.
It's set.
It's set. Set, yeah, Right now, it's pretty close to 10%. It's not exactly 10% for every bank, but...
Is that only for banks that are like members of the Federal Reserve?
No, this is for now all banks. All banks. And this is, I'm not just talking banks, I'm talking banking institutions. So banks, savings and loans, thrift stores, credit unions, all of those have a required reserve ratio set by the Fed, period. Basically, any company that can create checking accounts or savings accounts is now underneath the Fed's control. That's the Monetary Act of 1980. I mean, that's why the Fed's so powerful, guys. That's why everybody's a little bit afraid of the Fed, right? And on top of it, you guys now know that it's not a government agency, right? You don't vote for anybody on the Fed. You guys have no control over them. The Fed does whatever the hell it wants.
That's why you asked for our opinion.
That's right. Right. So should it be a government agency? Well, what's the government done so far to help the economy? So who's been doing most of the hard work to try and require the Feds? That's absolutely right. So for me, personally, I am happy that the Fed is not a government agency, because the government right now can't do, they can barely frickin' tie their shoes, right? Let alone actually do something to help the economy. So the person who's doing or the group that's doing the work right now is literally the Fed, right? And if you hear that phrase, quantitative easing, that's the Fed's doing.
Well, all the so-called illegal money, when they bust them and they get on that, then they put that back into.
What do you mean illegal money?
You know, like drugs, okay?
Okay.
You know, they have all the cash and all that kind of stuff, and then they go and they bust them, and it goes to, probably goes to lawyers and back to the government, right?
Uh-huh, uh-huh.
And then that goes back to the system, right?
Yeah. But again, realize that the Fed, technically all the cash that's out there, the Fed assumes that it's, in theory, being used for proper business practice, whatever, or economic growth, you know, whether it's illegal or not is, because they can't track the cash. They can keep track of how much cash there is, right? Because if you look at a dollar bill, it's got a little green number on every bill that comes out. That's a tracking number. They know that those numbers exist, period. That's how much cash is out there. So they have exactly how much cash is in the system at all times. Whether it's being used nefariously or correctly or, you know, buried in somebody's backyard, they don't know. But in theory, that is cash in the system, whether it's really being used or not. Again, that's well, yeah, I mean, people could be burning cash, and that, again, the Fed has to try and take that into account, right? Destruction of some of the dollar bills.
No, I meant when the Fed, like when
They burn it. Oh, yeah, whenever they burn a number, they recreate the same number, always. They're very good about that. To get rid of it. Well, what should they do with it? Well, again, the problem with $100 bills is that when they burn it, right, they're trying to relieve the residue that has been built upon the bill, and some of those bills have residue that's not so good, and or the money gets ripped, right? I mean, sometimes, paper is not that durable, so if you tear a dollar bill, what a bank does with a torn dollar bill is they send it back to the Fed. They'll burn the two halves and create a new one with the same number.
That and like old bills.
Yeah, old bills. They will try and recycle any bill that's older than 25 years. When the Fed gets it, they will burn it and make a new one. So 25 years is the lifespan of a dollar bill in our system, supposedly. Which is kind of why the U.S. government is trying to switch to coins instead of so many bills, because a coin lasts for about 100 years. True, but it would cost them less money to take care of money if the money itself would actually last longer, right? So the Brits kind of had something right? Where they have the 5-pound tuppence. Nah. And that's exactly why it won't. Because enough people will whine and complain about the money being too heavy. You don't use cash anyways, come on! Well, pretty soon they're just going to chip you, and you're going to be a value of money in.
That. See that movie about with
the time. Singer boy, whatever his name is. Yeah, no, it's Timberlake, right? All right, so. So the required reserve ratio right now in this country is somewhere between 9.5% and 11% for all banks. The bigger banks, the more secure banks, will actually have a lower required reserve ratio. Banks that are smaller actually have a little bit higher number. They have to save a little bit more money. But on average, required reserve ratio in this country is roughly 10%. Right? We'll get to it a little bit later, but this number used to be a little bit wider. If you'd have looked in 2008, the numbers were a little bit lower. There were some banks that only had an 8% required reserve ratio. They only had to keep 8% of their deposits. And the reason the Fed did that is because the banks were so huge that they were being forced to keep track and hold on to large sums of money that the bank couldn't use to make profit on. And so the banks were constantly whining to the Fed saying, hey, you're making us keep 8, 9, 10% of our money. it would be nicer if it were a lot lower. And so the Fed, being infinitely wise, lowered that number for them so they could do what they did in 2008 and 2009. Enough said. Yes, exactly. And they loaned it in a more scary and more risky fashion the more they did it. And,
Am I done with this lesson?
Again, this is, just so that you know, this method of adjusting the money supply, changing the required reserve ratio, the Fed has done it twice in its lifetime. Twice. During the Great Depression and during the Great Recession, right? During the Great Depression, the required reserve ratio was more like 12 to 15%, and what it was doing was actually stifling banks. They couldn't loan money out. And they actually lowered it to try and increase the money supply and make money cheaper and easier for people to get. Right? In 2008, 2009, the required reserve ratio was too low, and banks were being, oh yeah, careless is a ridiculous phrase. So the fact that they raised the required reserve ratio on some of the biggest banks from 8 up to 9.5%, I personally almost left the country. Because when the Fed changes this number, you know that the economy is absolutely effed up, period. Because this kind of a change, change this is like dropping a nuclear bomb on the economy. I mean, literally. This is a last resort move by the Fed when they are scared crapless, okay? So when I read that they had raised an entire 1.5 percentage points on some banks, I was like, holy. I mean, because I knew what was going to happen, right? Money was going to become really tight. It had to, right? There was nothing that you could stop it from doing, because this 1.5% change changed the money multiplier by a large enough number that instead of multiplying by, 11.5 or 12, now we're only multiplying by 10.5 or 10, and the Fed just didn't have the tools to push the economy forward, and unfortunately our government couldn't do it either, and so it was almost time to go to Canada or Switzerland or Mexico or heck the Cayman Islands, except I didn't have enough money yet.
But that's just going up, not down.
Yeah, going down is the other way. The going down, lowering this makes money cheaper, makes it easier, makes the money multiply faster. When you raise it, it's pulling it back. It's essentially saying make money tighter, make the money supply fall, right? So lowering the R will raise the money supply. And vice versa, right? Raising the R will lower the money supply. All right, so this is one of the Fed's large tools to manipulate the money supply. Now bear with me to some degree. You guys should understand a little bit about it. I mean, if there's more money in the system, what do people do? They spend more. So in general, more money in the system equals growing aggregate demand. Now chapter 20 takes you through the formal explanation of that, but in general, you should realize that more money is going to lead to more demand. I'll show you why, though, in chapter 20. But likewise, lowering the money supply generally slows things down, right? The harder money is to get, the less likely you are to get it and spend it. So tends to make sense to some degree. All right, so this is one thing that the Fed can change. And again, when they do change it, you guys should be nervous, okay? Period. I mean, the required reserve ratio does change, but it usually changes as hundredths of a percent, not whole percentage points. Whole percentage point changes in the required reserve ratio should make you very nervous, okay? Either way. Oh, it's on. You should be able to go to if you go to the Fed's website. The Fed actually has its own website. Federal Reserve. It's fed.gov. It might be federalreservesystem.gov. I don't remember which one it is off the top of my head. But if you go to their website, you can always do a required reserve ratio, and they'll tell you what it is, for most banks even. You can actually figure out what your bank specifically has as a required reserve ratio, and it'll be somewhere between these two numbers. unless, again, they're in trouble.
So to help the economy, why doesn't the Fed just lower the?
Because it's a really, really, really big bomb. I mean, in theory, they could try and do that, but the problem with it is that it's not controlled. Because they're not sure how much change in the money supply will happen by changing this number.
So why don't they do small increments at a time? When they went up 1.5%, why didn't they just try and?
Well, because the other thing that they want to have in the banking system is stability. And changing this on a regular basis, when they change this, banks take a long time to figure out how to adjust. All right, so imagine, if you will, that you were running a bank that had hundreds of millions of dollars of deposits, and now they changed this by 1/10 of a percentage point. That still means you need to come up with hundreds of thousands of dollars of extra reserves, which means that you have to potentially hunt for it or do things like sell equity to get it. And that, again, it's a lack of stability. So once you set this, you don't want to change it because it makes banks, yeah, and having banks be stable keeps prices stable. All right. So one of the other things that the Fed can do now, we did this back in Chapter 18, and I will remind you very quickly, just to be safe, that one of the other things the Fed does is it regulates all the banks, right? And it also said that Monetary Control Act of 1980, that any bank, if it needs to, can borrow money from the Fed, right? So imagine, if you will, that you're a credit union that you're a member of, nonprofit credit union, because you're trying not to proliferate the profiteering of banks, so you join a credit union. And
Shut up.
and so the credit union, so I'm a member of the credit union. I go to the credit union and I say, look, I need $1 million to start a business. And they look at me and say, well, what's your business? They're still going to ask, even me, reputable as I am. They will ask me, what's the business I want to start? I'll say, give them my business spiel, and they'll say, okay, you're worth $1 million. Now, imagine that bank doesn't have, that credit union doesn't have $1 million worth of excess reserves. In other words, that's the only money it can loan out, is excess reserves. Well, if they don't have the money, where do they go get it? They go to the Fed first. But they can go to another bank too, but we'll get there. So the Fed has something called the discount window. And what the discount window is a place for banks, any banking institution, to go and borrow excess reserves. So when my credit union that needs $1 million of excess reserves, if they don't have it on hand when I come to ask for the loan, and they know that if they don't give it to me today, what am I going to do?
Go find it somewhere else.
I'm going to go to the credit union next door, because there's always another one next door, and or it may be a block away, and I'll get it from them instead. And they're like, wait, we don't want to lose your business because your business is good for us. And when I borrow that $1 million, what are they going to do?
Give you an interest.
They're going to charge me interest, and that's where they make profit or earn money to pay for their CEO's salary, whatever. Credit unions have CEO, folks, and they make way the hell more money than I do. All of them do. Damn bastards. Anyways, right?
Question.
Yes, sir.
Can anyone borrow from the Fed?
No, you have to be a bank. The bank, only a banking institution can borrow from the Fed. This is why, again, why people, normal people like you and me, should think that the Fed is trying to make banks rich. Because we can't go and borrow money from them at a 0.5% interest rate, which is what they're charging currently. But banks can. And what does a bank do when they get a loan for 0.5% interest rate? They come back to me and say, oh, way more than, 3%, 4%, 5%, right?
The Monetary Act that allowed other banks to borrow from the Fed.
Uh-huh.
Why can't that apply to us? They just don't let it?
Well, because they also have to be worth the risk for the Fed to give them money. So the Fed can say no. So the Fed looks at every institution that asks for money at the discount window and says, is your banking situation solvent enough that we will loan you $1 million? If they are, they will. If they're not, they won't. So the Fed has the right to say no. They just also have the right to say yes.
Is that why so many people want to get loans and can't, because the banks themselves aren't stable enough to borrow from the Fed?
And the money supply is too low. Remember, it dropped by $3 trillion. There's a lot of money missing. Right? So the banks are trying to recuperate it all. And this is what the Fed's trying to do, is to pump the system such that it will generate more money in the system. All right? So the discount rate is the rate the Fed charges banks to borrow money. So once you guys own your own banks, which I assume you all will at some stage, because you're going to learn how easy it is to be a banker in this class and how much money you make. Right? So you will start your own bank, and you will discover that you can go and borrow money from the Fed. And again, the discount rates, they still charge interest. And remember that the Fed is a nonprofit organization. All the money that the Fed earns in interest, it actually donates back to the government. 0.5% interest rate.
Right, but you said that they give it all to the, like, how do, like, if I work for the Fed, how would I make money? Because
Well, you would get paid a salary, and the amount of money that, when the Fed earns interest on its loans or its investments, it takes the money that it earns and pays its employees. Any excess, any profit is given back to the government. It's actually put back into the Treasury fund. So this credit union says, great, I need $1 million, I go to the Fed, I get it. What happens if the Fed says no? What did you say first, Deanna? Where do banks go to borrow money? Yeah, exactly. So there is another rate out there, that's the federal funds rate, and this is what banks pay other banks to borrow money so that they can make loans, right? So the credit union next door to my credit union, they may have $1 million in excess reserves, but they just don't have anybody coming in to ask for it. Or anybody that's got such an amazing, brilliant business idea like I do coming in and asking for the money. So when my credit union calls the Fed and the Fed says no, they call the credit union next door, and the credit union next door says, oh, you got that Marshall Munt character? Sure, here's $1 million. And oh, by the way, we will charge you, 3/4 of interest on it.
And the Fed oversees that loan happening as well?
Oh, yes. It knows, because at the end of the day, both of the banks have to report to the Fed saying, this guy borrowed, that guy lent, what interest rate?
So what's the definition of the discount window?
The discount window is basically the Fed operates where banks are borrowing from each other, because the Fed's just a really big bank. But if you do a search for the discount rate, they will often tell you that it's the discount window. That's why I use the phrase now. Because when I go looking for the discount rate, you should really search for this first, and they'll give you these two from it. Basically, it's the bank begging window. That's the term. Okay, and this is like a large gun on the economy.
What is the discount window?
The discount window, yeah. When the Fed changes the discount window, this is when it's trying to, again, increase or decrease the money supply, but it's usually trying to do it at larger rates than normal, but they're much less than this. They're much more controlled, okay? So if you'd have looked back in 2008, 2007, the Fed was probably charging around 5 or 6% in its discount window. Nowadays, 0.5%. Again, the idea here is to make money cheaper for banks. So when they need to lend out money, the Fed wants it to be cheap, so they will lend it out, right? So even if my harebrained idea of a company is not all that great, maybe they'll still lend me the money because they only have to pay 0.5% interest to get it, all right? So before you flee, one last thing. These are the three tools the Fed have to manipulate the money supply. The required reserve ratio, the discount window, and the Federal Open Market Committee. The Federal Open Market buys and sells government securities on the market. No, the real market.
The one where they ding the bell in the morning to let you know it's open.
And this tool that they have, this is what's known as the fine-tooth comb. So when the Fed's trying to make a small change in the money supply, they will apply this tool, right? So if they're trying to manipulate the money supply, but they're just trying to do it in small incremental, trying to make a big, huge impact. These tend to make big impacts, right? This makes a little move, and it's also controlled, right? Remember that there are 12 branch banks in the Fed, and every one of them is analyzing their own money supply in their region. And so a lot of times what the Fed does at the national level is it says, wait, there's not enough cash in, money supply in the Midwest, but there's too much out on the East Coast. And so what the Fed will say is, okay, Federal Open Market Committee, lower the money supply in New York, but raise the money supply in the Midwest. And so in the market, the people in the Midwest will be buying up government securities to push money out into the system. In New York, where there's too much money, they'll be selling Treasury securities, saying you have too much money, here's some securities instead of money so that your money supply decreases. Because the Fed actually keeps track of the money supply in every region and tries to keep it even according to whatever they consider even. Even is relative to how much is being bought and sold. Right? Most of the money supply is on the East Coast or the West Coast because that's where people spend way the hell too much money. In the Midwest, we're the only frickin' area in the country that saves money, and this is where we don't need as much in the system. We just don't, right? Because we don't spend the way East and West Coasters do. It's also why we tend not to get hit as hard by recessions normally, unless entire industries crash that we count on. But we didn't quite make it through all of Chapter 19. I apologize for that. That's my fault, not yours. So there will be no homework over the weekend. If you want to start working on the homework, i.e. I'm not assigning this, but if you want to start working on it, the homework in Chapter 19 is 2, 6, 8, and 10. But I'm not going to assign that until next week.